We are very excited for our partners to be in the office today for a special podcast with our friends with Rogers Gray, who are our insurance folks. So if you guys would like to give yourselves an introduction, that'd be amazing, and we'll get right into it.
We're with Rogers Gray, Baldwin Risk Partner.
Names?
I'm Matt Carnuccio.
John Gaynier.
Yep.
So our specialty as an organization, we focus on real estate. Multifamily is the biggest segment of our real estate division. We write accounts throughout the country, somewhere between probably 1 million and 1.5 million units throughout the country. We know the space very well, happy to be here.
Very good. So obviously insurance has been one of the biggest hot buttons in the market right now. It's not just one thing that's changing. It's not just interest rates, but it's insurance. So we were kind of talking about this before, and I think it would be a really good topic just to start out with, which is just how did we get to where we are today? How did insurance go so crazy? I guess from maybe 2019 to today, what happened at that time that led us here?
Sure. So the insurance marketplace, if you went back, probably pre-2019, insurance for multifamily owners was not really a hot button issue. The cost was very cheap. We were in a very soft marketplace. The insurance marketplace is a marketplace just like any other. There are soft markets, there are hard markets. But what really led us to where we are today was, losses. Pricing was very cheap. There was a lot of competition, and there was a lot of aggregate or capital within the market, which was keeping those costs low. What happened over the last, since 2019, is we've had a lot of big storms, and those big storms have eroded carrier performance, which has put pressure on insurers and reinsurers to increase pricing. Post-COVID, inflation has also caused a dramatic impact on the insurance industry, because if we go back to prior to 2019, some areas of the country you might have been able to insure stuff for $75 a square foot, $85 a square foot. Now with inflation and the cost of construction going up so significantly, the carriers are now wanting to see $120 a square foot, $125, $150 for a fire-resistant building or more, right? And in different parts of the country, those would be kind of your rock bottom numbers. In different parts of the country, the construction cost is actually significantly higher than that. So if we say just in terms of the valuation, which the property is rated off of, the premium is rated off of, that's gone, it's essentially, approaching, almost doubling here at some point here in the future, right? So that's one aspect. The other is that if we look at what the claims had been historically, if you went 5 years ago to 10 years ago, the insurance industry averaged around $45 billion in insured claims that they would pay on an annual basis. The last 5 years have averaged close to $90 billion, right? So we're paying, double the amount in insured claims. So ultimately, that puts
You kind of
pressure.
had a double whammy, and you had at the same time the reinsurance market had to evaluate and say, well, not only have we been undervalued, because we were, that was sort of when the market was soft, you could undervalue, have access to these blanket policies, which was really the Cadillac of insurance. But as the claims doubled, and then it wasn't just a freak year, it became consistent, they needed to reset and underwrite for that. And they had to put a hard press on valuations and also really look at the rates. So there was probably a bit of an overreaction to the rate. The valuations are probably here to stay, though. I think that, as the market has come into 24, we've seen, at least, depending on where you're starting from, but we've seen those rates start to stabilize. We've seen the valuation stabilize too. So I don't think they're going to ever go down, to when you can really get away with sort of stripping the valuation in half and then taking advantage of certain insurance products. I think that day is over, but, we're kind of in a unique place right now on the property side. We're seeing a lot of the tier one, the coastal risk. Really, that was probably an overreaction the last couple of years when we saw these big spikes. So we've seen reductions on that side. But you go out into other parts of the country and even the convective wind areas up through the mid-Atlantic, Northeast, where there is more carrier appetite. That market has historically been more stable. That market still is seeing some increases, right? But the rates are lower to begin with. So everything's sort of leveling off a little bit right now.
In a tier one location is it's an insurance term for a location that would be in a coastal area. So this is typically going to be in your coastal areas all the way from Virginia through Texas, right? If you just drew a line, all the way.
They're going to capture
from
the
those two
counties,
states.
the
Correct.
counties that essentially border the ocean.
Correct. So doesn't mean that if you have a location in South Carolina that it's automatically going to be tier one. Tier one is going to be coastally located, right? So if you're in Columbia, South Carolina, that would not be a tier one location. But essentially, it's a way for the insurance industry to deem it as high risk from a hurricane standpoint.
And Florida is sort of its own unique state as well, which essentially every county in Florida is considered tier one.
Crazy. So, from a cost perspective, what has happened to cost roughly from a couple years ago? Call it 2019. I don't want to say 2020 because that's roughly COVID, but 2019 till now. Just ballpark estimate from where cost was to what costs are today.
Yeah, and it's going to differ by every marketplace. But if we're specifically talking about multifamily, in a lot of areas it's doubled. In some really challenging areas, it's potentially even tripled, right? And
on top of that, the amount of risk the insured is being asked to take on has increased dramatically too.
Yeah, insurance is not insurance. So we can be talking about different deductibles and so on and so forth. You guys know all the ins and outs.
Correct. All insurance is not purchased equally, right? I think a lot of multifamily owners talk about insurance and say, well, I'm paying this per unit, right? That's how their minds work. What is your cost per unit? But the things that we don't know when we, talk about cost per unit is, are we talking about 600 square foot units on average, or are we talking about 1,000 square foot, right? Those are obviously going to be two very different things. Additionally, do they purchase earthquake and flood coverage, right? Those are very different things that some purchase, some don't. We're not talking about, just a minimum what gets by the lender, and some purchase insurance that way. Others purchase insurance based on the risk that they have, and they approach it in a way to say, hey, I've worked a very long time to build up this business, and I don't want anything to happen, right? And so they buy more protection. Some take less deductibles. Some take higher deductibles, especially in wind-prone areas where it's, some may take a 2% or a 1% if they buy it down. Others may have 5 or 10 in some cases. So there can be big variances in what people purchase and how they purchase it.
I have a couple questions. So first, going back to the point that there was $45 billion in paid out claims and then $90 billion. Do you think that the rising cost of insurance creates a perverse incentive for owners to want to file more because they think, well, if I'm paying this much, I need to get my money's worth out of this insurance, and then they just try to file more claims and the price goes up and it's a vicious cycle?
Yeah, and it's a really good question, and we're in the fortunate position to see a lot of different owners and a lot of different operators. There are owner operators that view their insurance program as a maintenance program. So they kind of don't fix it until they have a claim, right? I'm not going to repair the roof, and then all of a sudden there's a storm that comes through, and hey, I got myself a new roof, right? There's others that view their loss history as, I want to keep this thing as clean as I can, and if I have a $100,000 deductible and the claim is $250, I'm just going to pay it out of pocket just to keep clean loss runs, so I'm always viewed as a good apple by the marketplace, right? So everybody views it a little bit differently. For those, who, are willing to kind of say, hey, I don't want to have anything on my loss runs, or I want them to be as clean as can be. We've seen a real push to property captives for some of those clients where they say, okay, insurance has gotten so expensive. I know my portfolio. I'm, better than the average of the marketplace, right? And I outperform the marketplace. So I want to take on a lot more risk to try to hold on to some of my premium, right? And I'm going to bet on myself, and that's been a strategy for those that, are really good performers.
But the data is there. I mean, the amount of natural disasters type of events has been increasing. So that, but it is an interesting point you bring up. So I think there's maybe a little of both happening, but the market's also protected itself. And I think that's why, meaning with the higher deductibles, I mean, last year was I think the worst convective wind, which really means hail, tornado loss on record in the US. And that stuff doesn't make the news as much as the big hurricanes, and storms, coastal storms. Yep. But the market's protected itself because we are still seeing it stabilize, with the large percentage deductibles on wind and hail. The insurance, the carriers have protected. So maybe not as many claims are being filed because of just the fact that they're not piercing the deductible.
And it's interesting if you talk about, let's say a convective windstorm area, Dallas. Dallas has a lot of hailstorms in that area. If you went back to 2019, most of our clients had a $25,000 hail deductible there. Now, most of them have anywhere from 2% to 5%, and that's of the total insured value for the location. So again, that would be if you have a $40 million location, insurable value, that deductible is now 2 or 5%, 3%, 4% of that total insured value. So they're taking on significantly more risk, which is protecting the carriers, more now. So we're, I think we're kind of at the tail end of this hard market for the time being, right? A big storm could push us right back into it, but at the moment, things are starting to soften a little bit in those areas that really had pricing skyrocket, in a meaningful way over the last few years.
Going back to the captive, because we worked on this a lot and ultimately decided not to go forward, but it's certainly still there at the ready, right, when we feel like it's necessary. So in your experience with your clients, what is the profile of owner who that are doing a captive and that have been successful with it, and what does that look like?
Yeah, so the type of client that takes on a captive is one that is a good performer, tends to not have a lot of claims. In multifamily, everybody does have claims from time to time. That's just a reality of owning property. But typically, they are going to outperform the rest of the market. That owner is also somebody who is kind of fed up with paying, for others' poor performance, right? Where when we talk about insurance is kind of a law of averages, right? You have a lot of people insured, right? And, they all perform, and whatever that performance is what the market is, right? Now, when you talk about a captive, it's just you, right? And it's based on your performance, right? And if you believe that you outperform the market, it can be a real advantage. But those owners are very comfortable with taking risk, right? And there is a lot of risk when you take a property captive, so it is not for everybody, right?
And size does play into that, right? Just for anyone that is listening, because it can be appealing if you're a property owner sitting there saying, well, I have performed very well and I want to pay myself these premiums and take on the risk. But there's really, the benefit, you need to have the bulk and the size and the premium dollars there to get it approved by an actuary, because, essentially you're putting that money into a loss fund to be reserved to pay claims. So if your schedule really doesn't, command the premium to build the captive, it won't work for, that particular insured anyways.
And depending on where you operate, does that kind of program and profile make sense as opposed to other places? Like, let's say if
I was just going to
It's
say
a
for
great,
coastal
it's a
guys.
great,
Yeah,
it's a
yeah.
great question, right? So the people that tend to take on captives are in coastal locations. They're in convective windstorm areas where they have a lot of wind, hail in those areas. Those are the ones that typically take on a captive. If you are located in, let's say, Michigan or Ohio, your cost of insurance is not typically significant enough to where you would want to take on a captive. There are other options in that marketplace.
And your deductibles are low, right?
Correct.
So you're
Yep.
getting into the parts where you're already, even on a traditional policy in the open market, you're taking so much risk anyways with, especially when the market really peaked, and there were parts of the country where we were seeing the 10% named windstorm deductibles, 5% wind hail deductibles. And when you apply that to large schedules, large properties, they're big deductibles. These are big numbers.
You're basically not insured.
You're
on
already
cases.
taking on
Yeah.
millions of dollars of risk. So when you say, okay, I'm going to take on a captive, you're taking on millions more. But at that point, it's I think one of the frustrations that we see with our clients is that they're saying, hey, I keep paying more and more for insurance. I get less and less. And in a lot of these events, I still have to pay out of pocket, right? So that's what's pushed some of them, especially, and again, in those coastal areas and convective windstorm areas, to say, I want to take on more risk.
One question is regarding Fannie and Freddie. How do they drive the market as far as creating these policies and influencing the market?
Well, I think that depending on how you buy insurance, right? We've seen Fannie and Freddie in particular really sort of start to crack down on how they evaluate. If you're in a tier 1 area, they're really scrutinizing the amount of limit that you're buying. If you're on what's called a blanket policy, so meaning you combine all your locations, you're purchasing a property insurance policy together for all your locations. And typically when we do that, we model your locations, right? So we come up with a probable maximum loss in the benchmark's a 250-year return period. And depending on what that number is, maybe we'll double it, right? If it's your portfolio suggests a $25 million probable maximum loss, we buy a $50 million per occurrence policy. Now, this has gone on for years, right? This is a very strategic and thoughtful way to transfer risk and buy insurance in the tier 1 marketplace. We've seen the lenders be a little bit slow to react and catch up to the market, and we've seen them really scrutinize how much limit they're going to force or try to force the insured to purchase based off their schedule.
And so in the last few years, as insurance has really skyrocketed, as Matt mentions that 250-year return period, and in his example, if it models out at $25 million as the probable maximum loss, some insureds, let's just say your entire portfolio was in New Orleans, and you can only really afford $5 million, right, in total coverage, or $10 million in total coverage, right, because the cost is just so exorbitant, or sometimes not even available in the marketplace. This goes back, a year or two ago. And Fannie and Freddie were pretty accepting of that, to be honest, over the last couple years, where it was that they kind of understood what was going on in the marketplace. What we're seeing now is they kind of understand that the market is maybe softening a little bit. There is more capacity in the market. And now they're making the insureds kind of jump back up from that 10 million to at least that 25 million, right? And they're kind of saying, like, okay, guys, we need to protect our investment, right, and make sure that the loan is, collateralized by insurance.
Makes sense. So naturally, when there's a lot of change, it hurts sponsors like us because we have to underwrite that into our equation when we acquire deals. So when we've got debt kind of going up on us and insurance going up on us, or if you close a deal and 2 years later your insurance is substantially higher, it absolutely destroys your expense ratios. So just for the investor at home, the capital partner at home, to conceptually think about this, if you get these increases, it really kind of can destroy your deal and all your free cash flow. That's why a lot of deals are struggling right now, why you need some capital infusions in them, pref infusions, to kind of reshuffle the equity structure, because these costs are getting more expensive. Insurance, labor, on the property, from, basically your managers.
Property taxes.
Yeah, it's just, everything's more expensive. It's just kind of the perfect storm to create a distressed market, make everything very challenging. And I'm sure with those challenges comes a lot of opportunity for you both, in the sense that, when things are really normal, you probably don't get as many phone calls, for the better or worse. But when things are really volatile and changing, your phones are probably ringing all the time. So it's a good time for you, probably, I imagine, to start new conversations and maybe even send out quotes and have new people kind of come into your systems just to see what we have to offer, I imagine.
Well, I think, look, I mean, it's a great comment, and there's a lot of truth to it, but we obsess about the market, right? I mean, the insurance place in multifamily is our niche. We study it, right? And we want to communicate that with our partners to help them deal with these challenges, right? We're on your side. And there are things that are in our control, out of our control. But if there's opportunity, if the market's changing and we're on top of it, we're going to communicate that with our insureds and help kind of coach them and give them the strategy on how to deal with it. And look, as for a growing business, when you're looking to acquire, you need to be educated on that. Otherwise, you'll get caught off guard. And I mean, that's sort of what at least I'm most passionate about, right, with my clients. I don't want them to feel like they're ever caught off guard with this market. And we're communicating what's going on behind the scenes. Because a lot of, look, there's a lot of variables that are going to impact things. Even for the market can change that fast, and we saw this happen coming out of January this year. The market sort of snowballed a little bit. You had a little bit of momentum going into some of those big, pre-hurricane season renewals. And now it's kind of adjusted back because we're in the middle of hurricane season. But it can change again, right? So you want to be ready. You want to be ready for opportunity. And that's kind of what at least gives us passion every day to do our job.
And, I think another point is to look, we have a good feel for the market and probably what's going to happen in the next 12 months. As you start talking about a lot of these deals that were done in 2018, 2017, 2019, right? And then there was this radical shift in the marketplace, right? We can forecast 12 months as you start to get outside of there, right? Nobody really knows what's going to happen, but you always need to prepare for the worst. I think what I could say about the insurance marketplace now is that the valuations are here to stay, and I think Matt hit on that earlier. Cost of construction, it may go down from time to time, but, I don't think it's going to go down too much anymore, right? I think we can all agree that, our new pricing is here to stay, right? It's really tough for it to go back down to where it was, years ago. So I think that is going to keep, insurance costs higher than they were traditionally. And then now I think we're in a new rate environment where we're going to see ebbs and flows, and maybe that's 20% higher, 20% lower than where we're at today. And that's really going to be based on, the storm activity and the loss activity in any given year, right? You will see corrections if the carriers have a bad year. If they have a good year, you're going to see corrections the other way. This year, we're seeing those corrections on the property side, and that's because performance has been better over the last couple of years. And so now we're starting to see in most markets, a compression of that pricing, and hopefully things will continue in this direction, and we won't have as many large losses or large events, that, the marketplace continues to be stable.
So we've been talking about costs going up, and many things are cyclical, like interest rates, for example. But to what extent is insurance cyclical?
It's it's a good question. And it's really tough to say. I mean, look, since if we go back, the last 100 years in insurance, there's been hard markets, there's been soft markets. I think anybody in insurance who's practicing now will tell you this is probably the longest hard market that anybody's ever seen who's alive at this point. Usually within insurance, hard markets tend to last maybe a year, maybe 2 years, max. This has been a prolonged hard market. It maybe isn't even, prolonged. It just is our new market, right? And this is, I think the baseline just got moved, and we are in our new market now.
It's going to be hard for that issue on the valuations. It was a lesson learned, right? Because these products were, in the marketplace where everyone was so devalued, the reinsurance companies paid for it, and they didn't underwrite for it. And I don't see that mistake happening, at least for some time, right? Where you can get those valuations that far underneath what the true insurance to value really should be. And you see most companies, and they've, we've come up. I mean, we were probably 50% insured to value on some schedules, and it had to kind of slowly build up. But it's always they're going to keep them right around there.
And to give an example of that, if we went back years and years ago, it wouldn't be uncommon to have, let's say, a location in Florida insured for $65 a square foot, right? And then all of a sudden they have a blanket policy. The carriers think they're on a location at $65 a square foot. The location gets wiped off the map in a hurricane. And then all of a sudden, the reinsurers are on the hook, right? The insurer has paid out their portion of it, and then it goes to the reinsurer, who they laid off part of the risk to. And the reinsurer is saying, hey, you told me this was $65 a square foot. Now it's costing $110 a square foot to rebuild. So you can kind of see how, the reinsurers got frustrated, and then they start raising rates, right, on the insurance companies. And then the insurance companies start raising rates on the clients,
and pushing the values. I mean,
and especially pushing the values, right? Because
but the rates will fluctuate.
Yep.
The rates will fluctuate. The valuations are likely going to remain stable.
Going back to captive, and then you can ask what you want. How do I feel like through a captive you'd be able to put together a policy that would be able to kind of, for those that want to minimize cost and therefore maximize risk, right? You still have to abide by Fannie and Freddie regulations so long as you're borrowing through them, right? Which pretty much that's the market standard, right? You can't really go away from what Fannie and Freddie are mandating as deductibles and coverages and stuff like that. So how does a captive marry to those standards?
Great question. So, we all know a lot of the big players in multifamily and some of the biggest companies, and many of those actually have captives within their structure, right? Typically, these are shared and layered structures of many different insurance carriers going up to a total limit, of insurance that they purchase. Now, a captive fits into one of those layers, typically the primary. It could be an excess layer for a really large company. But essentially, you're putting in a captive layer there. And what a captive is that you, instead of using traditional insurance there, you're going to put in your captive there, and you're going to get a fronting carrier to put a front on it. Essentially, what that means is that if we said, when we send off a certificate, if we show the captive name, right, the captive corporation, Fannie or Freddie is going to say, this isn't an A-rated carrier, right? You need to have A-rated paper, which is why you have a fronting carrier on your captive, right? So that fronting carrier basically says, okay, we'll let you use our paper, and then your captive is reinsuring to pay losses for that fronting carrier. That fronting carrier allows you to send out certificates to be approved by Fannie or Freddie. Now, what happens within the marketplace is Fannie or Freddie really isn't aware that there is captives, and there's captives throughout the marketplace because there is an A-rated carrier on all of these captives that are providing that fronting paper, and they are comfortable with the risk, and they've reviewed the collateral and the financials of the individual taking on the captive, and they're confident that they can pay losses based on that financial data. So it will pass Fannie and Freddie, and that's the mechanism by how it's done.
But the mechanism as well, to your point, Rob, it's not necessarily cheaper to do a captive. You're still paying a premium. You've created your own insurance company to take on whatever layer of coverage, typically the primary layer where the risk is. You're paying yourself or your captive company that premium. And there's also a lot of fees. You're paying fees to that fronting carrier. They don't do it for nothing. That's why size matters, right?
They also take risk too, right? It's not just that they're providing their name.
Ultimately, yes. I mean, ultimately, that fronting carrier has no intention to pay claims. But at the end of the day, you have to, post collateral. You have your premium associated with the, that you're paying into your captive, which builds your loss fund. If those things are all exhausted, there's risk. There's no doubt about it.
Right. Yeah. Interesting stuff.
So when people talk about carriers leaving a market, how does that affect pricing? Because usually when you hear that something's about to go up, I know California, for instance, I think State Farm, I don't know if they do multi and stuff like that, but that can't be good. And that kind of puts pressure on the other, competitors there, or gives them leverage to increase. So can you maybe walk through that and maybe debunk some stuff that, or maybe explain what that looks like?
It's a great question. So, if you think about a marketplace, and there are marketplaces that are the least expensive for multifamily, they have a lot of carriers in those marketplace, in that marketplace, right? There's a lot of competition. Frankly, in a lot of times, there's a lot of standard carriers, right? Standard carriers are going to be, kind of your household names, your Travelers, or your Greater New Yorks, or, companies that most have heard of, and they're standard insurance companies. Now, what happens when a marketplace starts to have a lot of losses, where those carriers, when you're a standard carrier, you have a lot more parameters on you as to what you can do in terms of increases that you give out, to your insureds. Because of those parameters, a lot of times they will just exit a market if they feel that they can no longer make money. Now, when your standard companies exit a marketplace, or really any carriers start exiting a marketplace, usually the first ones to exit are the ones that were probably the cheapest, right? Because they had the quickest underperformance, right? And all of a sudden, at that point, when they leave that marketplace, the cost of insurance just went up for everybody, because that carrier who was the most competitive is no longer there, right? When you talk about California specifically, there's been a lot of carriers there that have underperformed, right? And because they've underperformed, they exit that marketplace. And what happens, we see it in California, where some companies that are, still with some of these standard carriers or on kind of legacy policies, they're at 30 cents. But when they lose that coverage, then all of a sudden they're at 60 cents or 70 cents, right? Because that's where the rest of the market is. So it's a challenge, and it does happen, and usually it will happen when carriers are just not performing in that market, and it's
funny. That's what we've seen. Why I see this as a really interesting time for property insurance right now, because you're seeing sort of these two different things happen. You're seeing in the coastal areas, you're seeing a more capacity available, and you're seeing the rates compress. And then you're also seeing that these sweetheart deals that were out there, and these little, small admitted standard market, deals that were working in different parts of the country, pull out, or they put capacity restrictions in. We've seen a lot of that too, especially in multifamily, where we can no longer write a property if it's over 20 million in total insurable value. And then all of a sudden you're out, where you had this 15, 20 cent rate, and now it's adjustment time, because now you're adjusting to the market, and you're going from a 20 cent rate to a 40. I mean, you're going up 100%. And while we're seeing sort of the other parts of the country who were definitely overpaying for the last 3 or 4 years get reductions, it all depends on where you're starting from and what you currently have, and you could be vulnerable. I mean, that's something to be on the lookout for. If you've been, within this, admitted marketplace on a standard company deal, and you get that non-renewal, you may not even know it's coming until 60 or 90 days before the renewal, and you might get it. But it's something you want to be on the lookout for, because it's a big adjustment that I'm seeing insureds. I mean, that's why my phone rings, where they say, I just got dropped, I didn't know it was coming, and my rates are going way up.
Yeah. And what would you say, generally speaking, right now are some of the hardest places to do insurance in, and some of the more favorable ones?
Sure.
We should touch on the liability market.
Sure, and we'll
miss that.
hit
I'll
that
make a
next.
note of that, and we'll circle back.
Certainly your most expensive areas of the country are going to be anything coastal down south, right? So the entire state of Florida is difficult from a property standpoint. New Orleans, Louisiana, right? Houston is a difficult market, right? Those are going to be your most expensive markets because they're coastally located. Now, after that, your next most difficult markets are going to be the ones that are exposed to convective storm. In California, wildfire exposure, right? So California can be a difficult market. Texas, just interior Texas is very difficult. Oklahoma, these are your challenging markets where there's repeat claims year after year after year, right? But when we talk about the markets that are typically the cheapest in terms of insurance, your Michigans, your Ohios, your
Arizona, non-coastal Carolinas,
non-coastal, kind of not too much happens in those areas. The Northeast, we feel is pretty predictable
what
as
you
well.
do get in the Northeast and even out west too, though, is the valuations are going to be higher. So you have to take that into consideration too. Whereas we can insure to value, at 115 to 125 a foot down south. You go up north, the rates are going to be lower, but the carriers are going to want that $150, $175 a foot on the valuation. Just
That's
the
due to
cost.
labor.
Yep.
Labor costs, yeah.
Yeah. So one thing I want to go back to is you mentioned we're on the same team. We often talk about pulling on the same side of the rope. So, and I think there's a lot of opacity in the insurance market. So a lot of people are used to going out, and if it's construction work, they go and get 3 bids, and then they figure out scope and price, and then they go for it. And then debt, they go and get 3 bids, 3 quotes from different lenders, right? So in the insurance market, it's quite different actually. So how does that work, and how do you kind of pull back on the curtain and kind of reduce the opacity?
Sure. It's a really good question, and it's become very difficult for insurers to really compete their insurance, right? And to compete it without actually hurting themselves, right? And what I mean by that is, for those that have a layered program, have typically 1,000 units or more, and have a layered insurance program, what happens is, over the last few years, there's been limited capacity in the marketplace, right? So the insurers can only write so much multifamily, and they know that they're going to get rid of all of that limit. And it got tough to even just fill all the capacity at a particular time that you would need for your insured, right? So if, let's say, Matt and I were with different firms and competing against each other, if Matt says, I want all these carriers, and I say, I want all these carriers, and you split them 50-50, what would happen is we would both come back with mediocre pricing and mediocre deals, right? And you, the insured, end up with mediocrity. Now, we encourage insureds to say, interview who you want for a broker, pick your broker, have confidence in them that they're going to bring you, exactly what they're saying they're going to bring you. And, ultimately, you're best to just put your trust in one individual, give them the entire marketplace, and let them do what they do. And that will achieve the best pricing for you.
And it does. It takes a tremendous amount of trust to do that. And it's a different industry because, you need to, or the insured also needs to understand, our job too is to manage the relationships with these underwriters too, and how you are represented in the marketplace. Because I can't tell you how many times, we do get opportunities, or, something comes in across our desk and we start to have conversations with the market. And when we hear from the underwriters, they're like, yeah, I've seen this deal 15 times in the last 2 years. I don't want to work on it.
From 15 different brokers,
from 15
right?
Different brokers.
Where it's they just kind of know at that point that it's not a real opportunity for them.
And the underwriters have been, look, because of the market conditions, every account's going to market, and that's okay. But you got to have the right story. But these underwriters are sitting there with, I've talked to one a couple weeks ago, she had 1,400 submissions on her desk. So they have to value their time too. And it's important that, we build those, we're just as strong on that relationship side as we are with our insureds, that we have to manage the marketplace. And in order to get that result, it's not as much as, construction is a bidding environment, and, or getting debt is a bidding environment. Insurance is bidding too, but you have to be strategic in how you do it. And you got to trust who you're working with to, get those kind of results and create the competition.
Obviously, this would never happen with us, but do you ever feel like there's almost like a fight between the sponsor, your client, and you guys, because expectations can be off, especially when things are crazy? And, it can be a tough business being in sales like that, kind of providing a product like this. Sometimes it's not the most sexy thing, but it's truly a necessity. So do you feel that kind of pain and struggle? Because there's a balance between, making money and doing the right thing, but it has to make sense for all parties.
Sure, it's
It would never happen with us, though.
Yeah, no. Look, for me, before this hard market started, I had 0 gray hair. Now I'm all gray, right? It's been a challenge, right? Over the last 5 years, we've been in the business of delivering bad news, right, to our clients, right, because of the marketplace conditions, and that's a challenging thing, right? And it's the key, I think to it is that we just try to be as upfront as we can with the clients, about what is going to happen, what we expect to happen, be on time with that delivery of those proposals. It gets difficult within the marketplace sometimes, especially when, like Matt's saying, somebody has 1,600 submissions. But, it's been challenging, and we just try to do the best that we can do in those situations and prepare our clients well ahead of time for what's coming.
And that can be a frustration for us because we don't like delivering late news, right? And inevitably there are situations when things come in late and it can be out of our control, and we will over communicate along the way. But the market, has been flooded, and, if you're accessing, more obscure parts of the marketplace which we do, we're in the Bermuda market, we're in London, and sometimes getting the information that we need to deliver takes time. And there can be frustration that we see happen within the market, right? Because everybody needs it now, and it can be hard to always, deliver on that on time.
Especially when deals, we've talked about this before in other subjects, but when we do deals, it's never like, or I guess I should say, it's rarely like, oh yeah, you didn't thread the needle, because if you didn't do that, then you wildly overpaid. And the markets are so fluid and competitive right now, there's never just one, bidder on a property usually. So people kind of have to have their information and have it like yesterday for them to feel confident on their best and final. But if you're waiting on a chain of command, there's only so much you can do there. So I totally see the friction there and the push and the pull that you guys have, because you don't want to misquote and just, flippantly say something when it could come back and kind of hurt the sponsor or, something of that nature.
Yeah, for us, specifically talking about acquisition, the nice part about acquisition is, with us specializing in multifamily, we really have a good pulse on the market, and we can provide that knowledge of, hey, if you do pick up this asset, it's going to be within this range. And we are pretty good at delivering on those expectations, right? We'll give our clients a high and a low, and this is what we're expecting. And, I would say nine times out of 10, it's within those margins, and we do a really good job of predicting the market. So that helps our clients as they see it time and time again, that, obviously everybody wants to try to go with the low number every single time, right? But, we try to give as much knowledge as we can.
Too. I mean, when we work with our insureds on acquisitions, we will provide the data. And then if it merits a conversation, because, hey, Matt, we really like this deal and you're at, $1,200 a unit, if we take the middle ground, we really need to be at 900. And, if we can be at 900, we could do this deal. And then we can have a real conversation where it's, if that's possible, and it could be, but these are the variables that might impact it. And that's not a guarantee, but, that's helpful knowledge for us too. It's not that, hey, just show us the number, show us the range, best you can do, best and final. We're a team, right? What's the number that you need, right, to aggressively pencil and win this deal? We want to help with that.
And what are the options that an insured has when it comes to sharpening their pencil and getting from 1,200 to 900? Is it just...
It depends on the asset, obviously, right? And the amount and the data we have, right? If we have good data, we know the loss, we get the loss history. I will say this in acquisitions, dealing with a lot of large portfolios, when the market changes and you want to be able to maybe change insurance carriers and switch your program, having good loss data is so key in this market. The underwriters want it. So when you're doing an acquisition, we see this all the time where I've got these 5 assets that I bought 2 years ago, so I only have 2 years of loss data. That's your opportunity to grab the loss data, right? When you're actually engaged in that due diligence period, get as much loss data as you can. But to answer your question, yes. So if it's in an area, so we see this in Texas a lot, where if it's outside of Houston and or if it's even in Houston, but it's a brand new construction, for example, and we know it has clean data, it may have an opportunity to go to a standalone carrier instead of your master, in which case we could get more competitive pricing. So we just want to know if this is a real opportunity. We want to deliver these indications so you guys can move quickly. But if it's something that, hey, best and finals coming, we want you to take a more, focused look at this one, we'll make the phone calls and we can try to drill down on that lower number and with a higher level of confidence that we can deliver on that.
Mm-hmm. So you mentioned age of the property. So how does age affect insurance?
Yeah, it's a great question. As the market's gotten more difficult, all carriers out there have started to tighten the window of what they will accept, what they won't accept. The carriers that tend to be the most competitive typically want the newer, nicer locations, right? And they will put parameters on, we're not going to take anything older than 2005 construction, or, might be for some, in the Northeast, maybe nothing older than 1950, right? Every carrier has their own box that they want to write in that they feel is going to make them successful. And if they write within that, inside that box, they feel they will generate underwriting profit. So, it's not just age of building. It can be
Age of roof,
age of roof. It can be, there's carriers that like the new podium style construction. There's others that like the garden style. When we kind of dig into that, some like the garden style because they know if they have a fire, that fire is going to be, a maximum of a $2 million loss, right? And that's their probable maximum loss in an individual event from a fire perspective. Now, the podium buildings, on the other hand, typically don't burn down as much, but when they do, you could have a 40 or a $50 million loss, and that one's pretty big on the balance sheet, right?
Yeah.
So
Meritage doesn't go down on us,
right? So it's everybody just views things a little bit different. And their reinsurers also are viewing it differently, right? So they have contracts with reinsurers, and those reinsurers can dictate what they can do and not do, and how much risk they can take, how much value they can take on a per building basis. So that impacts it as well.
But older vintage tends to be more challenging. And we see, if it's especially 60s, 70s vintage, you see a lot of aluminum wiring, you see Federal Pacific stab block breakers. So that'll greatly restrict the appetite, within the market.
I feel like in 5 years ago, 3 years ago, if you had stab locks, it was a death sentence. But I feel like maybe I'm wrong, but I feel like it's gotten a little bit easier.
Most of them have been phased. I mean,
Fixed, replaced.
Most have been fixed and replaced because what happens is there's such a limited market that of carriers that will accept it, and they're 3 times the price of what the traditional market is. That'll make somebody fix it pretty quickly, right? And so, but aluminum wiring, has always been a difficult area and continues to be a difficult area. Obviously, if it's unremediated, it's a very big challenge. Even if it is remediated, some of the carriers are, they don't love it. They will accept it. It's certainly a better risk. Most prefer that there's just no aluminum wiring at all. But, there are, some things that will limit your ability to find competitive pricing within the market.
So speaking back to something I wanted to just double click on, the liability market. So can we just break down what that means, what that is, and what kind of the thoughts that you wanted to hit on?
Yeah, so, we've been talking pretty much at length about the property insurance market. And look, when we're talking multifamily, typically, that property number is the bulk of the premium, right? Or it's 70% of it, or whatever the case may be. So that tends to get a little bit more attention. And the liability market has been probably more under the radar in the last couple years, but we've seen, especially this year, we've seen a big shift in the amount of attention that underwriters are giving on the liability side. We've seen crime scores become a huge part of underwriting for liability, and based on what you get, and that's not something that we can control. They have their own proprietary tool they use to evaluate the crime scores. I mean, they'll go on and Google reviews of your apartments to try to determine if they're going to allow what we call clean form coverage on the liability. So what we're seeing now is many policies are being issued with assault and battery, either sublimits or exclusions. abuse and molestation being sublimited or excluded from the policy, and also firearms, which is a key being in many cases completely excluded from coverage. And it's important to be aware of that for a couple reasons. A, the sublimits can range. So when I say an assault and battery sublimit, typically your liability policy is going to pay $1 million per occurrence, $2 million in the aggregate, and then you purchase an umbrella that sits over top of that, up to whatever the case may be. If you have sublimits on your assault and battery or firearms or abuse and molestation, that policy may only pay $100,000 per occurrence, maybe $300,000 in the aggregate, and then that does not go into your umbrella. So your coverage stops there. And that can be a pretty significant change if you're not looking out for it at your renewal when you previously had a clean form.
And now the reason behind why carriers are doing that is because they're paying a lot more claims in those areas than they ever have before, right? Once a carrier starts limiting coverage in a particular area, it means that they're paying a lot of claims and they no longer want to pay a lot of claims, right? So the concern with that is that you're starting to see multifamily owners have general liability policies where they have all of these limitations, right? And a lot of this goes by state as well, and the legal system within that state. And some states like North Carolina are perfectly fine and everybody likes to write there. States like Georgia, Florida, New York, California, there's a lot of difficulty in those states to find clean forms, especially if you have locations that are in high crime areas or maybe not even high crime areas, but they just don't score all that well from a crime standpoint. And one of the other limitations that Matt didn't mention is, really in California, we talk about habitability is also an exclusion that you'll see there, and it's because a lot of claims have been paid. Not just the state, but the judgments that are being, placed are a lot bigger than they ever have been historically as well. And that's another thing that's really driving this market. So what you're seeing within the liability market is, in some cases, limitations on the coverage. Additionally, we're also seeing more retentions where, most everything within liability years ago used to be, for multifamily, used to be first dollar coverage. And then you started seeing 5,000 SIRs, that's self-insured retention, essentially a deductible, but it would go from 5 to 10 for large organizations. They might be taking 100, right? For those that haven't performed very well, it can be higher than that, and that's on a per claim basis a lot of times. So there's a lot of challenges in that marketplace, and where property is improving right now, liability is getting more challenging, and we are seeing increases on that side.
So I don't think a lot of people think about crime when they think about insurance. So what does that look like? Like, what would a claim look like if someone has assault or if they have firearms or something like that?
Sure. To give you an example, and I'll take a market, let's just say Atlanta, right, which is a very challenging market at the moment. What will happen, in Atlanta is you could have a shooting at an apartment complex. Has nothing to do with you, the owner, was not your fault or your responsibility. Could be a domestic dispute, could be a drive-by shooting, whatever the case may be. What's happening is the deceased family, those that got injured, whoever, are bringing lawsuits against the owners. And those,
not the individuals who did the crime, but the
the
people
owners.
who have
Yeah.
that
money
is
from
correct,
the property
right?
perspective.
Because
It's perfect.
at the
It all makes sense.
At the end of the day, we're going to whoever has the deepest pockets, and that is
It's their fault.
that is the owners, right? And the problem is that it's paying out, and it's paying
Yeah,
out
that's
big
because
sums of
We're
money.
doing it because it works.
Correct.
Mhm.
That's brutal.
And so that's one of the big challenges. Some states are trying to, curb this. Florida, which has been a very challenging state, has just passed tort reform. So, hopefully we'll see improvements in some of these legal systems that will, keep some of the stuff at bay. But that's one of our biggest challenges is kind of these nuclear judgments, and it doesn't have anything to do with you, the owner. You didn't do anything wrong, but it's still paying, and that's a challenge.
But being a good operator, and I know we learned a lot at the conference the last couple of days. There are things you can do to help mitigate risk, and the liability side is a challenge right now. But doing those night walks to see where there's parts of your property that aren't maybe well lit, and some things are easy fixes. There are things you can do, right? And you can do risk and loss control at your locations. You can be proactive to try to mitigate the claims, and that's really how you can have an edge in this market. Because once you get hit with some shootings or potential assault and battery issues at a location, you're not going to get that coverage in this market.
So we talked about property captive. What about liability captive? If an owner is a goody two shoes and they don't have any shootings at their property, how do they go about that?
Yeah,
Probably not workforce.
Yeah, it's a great question. Liability captives have become, more popular as well for people in the multi industry. Again, same process as the property. The one thing that's nice about the liability is if you take on your normal liability policy, which is $1 million per occurrence, a $2 million aggregate, you know exactly what you stand to lose within that captive. When we talk about property and you say, I want to take on my first $5 million of risk, it's $5 million per occurrence, and you don't know how many occurrences you're going to have. In liability, we have an aggregate there that says how much we can
But if you
lose.
have per location ag, you do have exposure.
But you
the
still
portfolio. But it's capped. Yeah.
It's capped, right? And you still know what that exposure is. Now, the liability, I think some shy away from it for a couple reasons. Maybe it's a little bit uncontrollable. Maybe it might be the states that they're in. But others, that are, have performed will take that risk. Now, what's different about liability and talking in terms of the captive and when you get your money back on a property captive, if we have a property claim, we know it, and it happened today, we know it today, right? Because we had a fire and we know it, and that way we'll close that claim and we'll get our money back from the captive, right? Or our retained earnings. For liability, a liability claim happens today. We sometimes don't get notice of it for a year, 2 years, right? Where it has a much longer tail, and to where you're going to see your retained earnings if you do perform, right? Because that tail is a lot longer on a liability claim because of, the delayed reporting of some of those incidents.
And so is that just an advantage for float, and you can make interest or you can make a return on float better because of the duration of the claim?
It's possible, but that money there is there to pay the claims, right? So you're typically not going to have that invested in any sort of meaningful way because you don't want to put that money at
they
risk.
won't let you.
So you weren't implying that. What you were implying was instead
what
that
I'm
it's actually a negative.
It's a negative
stuck.
because even if you feel like you performed, your policy period could be done and you had 0 claims, but then all of a sudden in a year later you have all these claims that start funneling in, and some of them big, and so it's one of those things where it takes a lot longer to get your money back in a captive than it would on the property side.
So going back to crime and different states and locations, not to get political, but red states and blue states, is there some groups that won't insure based upon that, or is there liabilities with crime and whatnot? Because there's some states that are having obviously more crime, and some cities and pockets that are obviously more crime riddled than others. How does that affect and play into the process?
I mean, whether it's a red state or a blue state, I could give examples of both that say,
it's by county too.
Yeah.
They'll go county to county, to determine. Yep.
Yeah. Yeah, and whether it's a red state or blue state, there's some blue states that are really bad. There's some red states that are really bad. It really, it just kind of goes back to whatever their legal system has been since they've been created. Like, let's just say North Carolina, North Carolina is a contributory negligence state, which means that we just don't see that many big claims there, right? Where you take that example of a drive-by shooting, right? And you could go to the, you know, they could sue the owner, and it's just not
Just
going
gonna
to
get
pay
dropped,
there,
yeah.
right? Based on their legal system. Now, in Georgia, in Florida, in New York, it's going to pay, right? And it's just based on the nature of their legal systems.
Is there any questions or any topics that we have not mentioned that you think would be important for everyone to think about as we kind of start wrapping up the conversation here today?
I mean, I think we touched a lot, so you can we can go on forever. We can get into the weeds. I think being, it's not cautious, but evaluating the current market condition, especially going back to at least on the property side, knowing where you are right now, right? Having that evaluation done, like, based on my portfolio, where do I stand in the market? And if there's, insureds out there that don't feel really solid and comfortable with that knowledge right now, it's important to know. Otherwise, you could get caught off guard. And same on the liability side too. Just kind of being aware of what coverages you currently have, and where your properties are located and what potential challenges you might face at this next renewal.
Yeah, I think one of the things that we talk about within our process and to our insureds that we think works really well is we try to communicate with them well ahead of time as to what they should be expecting for their renewal. We try to talk to them and understand their business as well as we possibly can, and the things that they do that make them different, especially from a risk management standpoint, right? What are the things that you're doing? We try to create a big narrative around that for when we go to the marketplace to separate them from the typical competition. We feel like that makes a big difference, and we try to, just good communication and staying on track before the renewal, and alleviating any surprises, can make for a much better insurance experience in a difficult marketplace. So, just that process we feel, is something that insureds, should expect from their broker, right? And it shouldn't be hey, here's your renewal quote, no time to digest it, didn't prepare you for what you were going to see, gun to your head, sign it now, right? And, we talk to a lot of insureds that have had that process, and, if that's the kind of process that you're in, I would recommend maybe taking a step back and having some conversations around the marketplace to see, are we in the right place? Are we doing the right things? Because insurance is something that has become a real challenge and a real topic for anybody owning property.
Well, it's not going away, and it's only going to continue to evolve. Thank you guys so much for your partnership, for your efforts to work with us. Looking forward to doing many more deals. And for those who want to get in touch with you, to kind of do business with you, shop it around, how can they get in touch with you? How can listeners?
Yeah, I mean, you can connect with me via LinkedIn, reach out. I'm always happy to share information. I think going back to, if anybody's interested to just kind of understand, here's where I'm at right now, what do you expect? That's a really good place to start. But you can go on our website. I mean,
on our website, or my email is John Gaynier, so it's John JOHN.Gaynier GAYNIER @RogersGray.com.
Well, thank you so much for listening. Insurance, it's the necessary evil in the business, but thank you so much for coming on here and applying us with your knowledge, and we hope to do another episode with you guys in the near future.
Awesome. Thank you for having
Excellent.
us. Yeah.
Thanks, guys.